So welcome everybody to this week's problem set, which will deal with chapter number 10 with the topic taxation of business income. So question number 1, you are a manager of a company that just spent $80,000 to purchase a piece of equipment that is expected to function for 5 years. If you can borrow money at 5%, which means that the interest rate is 5%, what is the present, so the PDV stands for the present discounted value. So what is the present discounted value of the depreciation allowance under the following circumstances? So we will consider 3 cases. First, you can expand the investment. Okay, so the first one was that we can simply expense the investment. So if you can expense the investment, the company can fully take the $80,000 as tax deduction immediately. So basically, since you're allowed to expense the investment, it means that you can, in the first period, you can fully deduct the $80,000 of investment. So if you can do this in the first period, it means that the PDV is simply $80,000. So we do not need to discount it actually at all because we can deduct it immediately in the first period. So this was A. Now B was the following. So in B, you use the straight linear depreciation method. Okay, so this is basically a method where you're dividing the amount of investment by the years which it is expected to function. And this is the deduction that you can use each year. And therefore, we need to discount those values which are lying in the future. Okay, so straight, oops, sorry, this is wrong. Oh no, this is correct. Straight line depreciation. It's also called linear depreciation, at least in Germany. So it means that you divide the amount by the numbers, or by the number of years which the equipment is expected to function. The result is the amount that you can deduct each year over the next 5 years. Okay, so this is the straight line depreciation or the linear depreciation. So if we divide the $80,000, so 80,000 by the amount of years which this piece of equipment is expected to function, it was 5, we get $16,000. So $16,000 is the amount that we can deduct each year over the next 5 years. But since there is something that we deduct so some of the deductions are happening in the future, we need to discount them with the according interest rate, which was 5%. So therefore, the present discounted value is then 16,000 plus 16,000 divided by 1.05. And for the rest, I will just simply copy this because I will use this over and over again. So then let me also copy the plus. So I just and make all the things smaller here. So I just have enough space. Sorry, just 1 second. So I think this should be fine. So then I copy this part here. So the first term is denoting basically the amount that I can deduct this year. So this is 16,000 dollars. The next year, from today's perspective, is then 16,000 dollars divided by 1.05 because I need to discount since it's in the future. To this, you add 16,000 divided by 1.05 by the power of 2. Then we add 2 more terms because this year was for the 3rd year. Then this one here is for the 4th year, which you, from today's perspective, discount by the power of 3. And the final term is in 5 years, which you discount by the power of 4. And this will roughly give you 72,735. Yeah, so as you can see, this is lower than the amount that we had in A when we were allowed to fully expense the investment in the first period. And the reason is simply because some of the deductions here are lying in the future. And since there is the interest rate and I could invest the full 80,000 in the first period instead of getting the deductions in the next years, this is the reason why you have a difference between the two present discounted values. Okay, so let us have a look on the next method. So you depreciate over 4 years using accelerated straight line depreciation methods. So this is a kind of a non-linear depreciation method, even though it's called straight line depreciation, because now what you do is that you deduct. Sorry, there was one thing missing. Let me just check. Okay, never mind. Sorry. So in C, you depreciate over 4 years using accelerated straight line depreciation methods. So it's not nonlinear. I was switching it up with sub-exercise D. So in C, what's happening is that instead of depreciating over 5 years, you do it over 4 years. And that's why it's called accelerated depreciation method. So then what we do again is we divide the amount of investment, 80,000, by the amount of years that we're going to depreciate. That's 4. So we can deduct $20,000 each year. And then if we calculate the present discounted value of this, it's 20,000 plus 20,000 divided by 1.05 plus 20,000 divided by 1.05 by the power of 2. And finally, for the fourth year, it's 20,000 divided by 1.05 by the power of 3. And this is roughly $74,464. And since it's accelerated, it means that I'm getting more of my money with respect to deduction back earlier compared to sub-exercise B. And this is the reason why the present discounted value with this method is higher than the one where I would linearly depreciate over the full 5 years. Yeah, so the sooner I can deduct the amount that I invested, the higher is the present discount value because I can take this money, the benefit, and invest it in some other projects, which would give me some return. Okay, then finally, this was what I switched up earlier. So finally, we come to a depreciation method, which is called the augmented accelerated method. This is a nonlinear depreciation method. This is what I was referring to before, wrongly. So now what you do is that half of the asset value is depreciated immediately, and the other half is straight line depreciated over the remaining 3 years. Okay, so again, since it's only the 4 years, so we're not considering the full 5 years, it's accelerated and it's augmented because we immediately deduct half of the payments. Okay, so now 40,000 can be deducted immediately, and then what we do is we take the remaining 40,000 divided by 3, which gives us approximately 30,333. This can be deducted over the next 3 years. So what we then get as the present discounted value is simply 40,000, which is the first, like the half that we can expense immediately, plus 30,333 divided by 1.05 plus again 30,333 divided by 1.05 by the power of 2. And finally, for the last year, which is the fourth year, we have 30,333 divided by 1.05 by the power of 3. And this will roughly give us $76,309. And if you compare, again, this present discounted value with the one that we had above, here you see that it's again larger. And again, the reason for this is because we are allowed to deduct more of our investment in earlier times, and as a consequence, the present discounted value is faster or is higher, not faster, it's higher in sub-exercise D compared to any of the depreciation methods that we considered in the sub-exercises before, except for sub-exercise A, where we were allowed to fully deduct the 80,000 in the first period. And this finishes exercise number 1. So, exercise number 2. Suppose that new machines cost $504 and the marginal benefit from new machines is given by 246 minus 6 times K, where K is the number of machines purchased. The depreciation rate is 15% and the dividend yield is 10%. So you can see, or you can interpret the depreciation rate and the dividend yield as some type of costs that you have. Okay, so because the dividend yield is something that you need to pay out to your shareholders, depending on what your profit or your outcome whatever your outcome is, if it's return or if it's profit, this is something that you need to pay to your shareholders. Yeah, so it's a cost for the firm. Okay, in sub-exercise A, we are asked the following: what amount of capital will you purchase and why? Okay, so as it's quite typical, you have costs on the one side in this exercise and you have benefits on the other sides. Here the benefits are already kind of represented by the marginal benefit. Now we also need to find out what the costs actually are. So the costs, the costs, the cost is, or the costs are given, to be precise, the costs are given by the sum, or the marginal costs, sorry, just to be precise. The marginal costs are given by the sum of depreciation and required returns. Okay, so this or those two things represent the marginal costs for the machine or for the firm, basically. So for each machine, the costs or the marginal costs are then 0.15, which is the depreciation rate, plus 0.1 times the value or the cost of the machine, so $504. That's the investment basically. And this is $126. So those are the marginal costs for each machine, and the marginal benefit is, and this was given in the exercise description, so it's 246 minus 6 times k, and in optimum, the following must hold. Marginal benefits, which I will shortcut with MB, should equal marginal costs, which I shortcut with MC. So we have already determined the both values. So we simply set 246 minus 6 times k equal to the marginal costs for each machine, which is 126. Of course, the marginal benefit here, it's referring to each machine. Yeah, sorry, I was thinking that it's referring to the machines as a whole, so all the machines that you purchase, but no, it's obviously just from one machine. So in optimum, the marginal benefit must be equal to the marginal cost, and by solving this condition here, you get k star is equal to 20. Okay, so this means that this is the amount of capital that we will purchase in order to maximize your profit. Okay, then we go to sub-exercise B. Because here there is a slight change. So in B, what we have is that there is a tax rate on cash earnings minus labor costs. And since we have no labor costs in this exercise, it doesn't matter actually. So we only consider now the tax rate on cash earnings. And then we will determine what the optimal amount of capital is if we have this tax rate. So the tax rate reduces return to capital. So by 25%. So the condition in which the marginal benefit is equal to the marginal costs is now slightly different. So there is no change with respect to the marginal cost. It's still 126. But what we get is for each marginal benefit will now be reduced. So depending on the capital, the marginal benefit will now be reduced by 25%. So we multiply with 1 minus 0.25, which is then the tax rate. We multiply the marginal benefit from machines, so 236 minus 6 times k. And this is now the new condition which determines the optimal amount of capital, which maximizes our profits. And if you solve this, what you will get is that k star is now equal to 13. So if you compare this with the optimal amount of capital that we had before, which was 20, you see that there is a reduction. So the tax rate reduces capital by 7 units. So in this simple model, as you can see, if there is a tax on kind of the profit or the return or whatever, you see that the tax here is decreasing the amount of investment here in a sense of measured in capital units, basically. So taxes here are decreasing the amount of investments in capital by the company. And this finishes exercise number 2.